Hey, this is Matt from InvestiQuant. Today is Wednesday, September 15, 2021. The markets continue to pull back from these all-time highs. Yesterday, we saw a new 10-day low in the markets, and we closed down there as well. So what we'll be looking at this morning is what has happened following a 10-day low close in a bull market environment. So let me go ahead and get this set up. I've got all four instruments selected. The setup we'll be looking at will be based upon entering the market long at 9:30 a.m. Eastern Time and exiting at 4:15 p.m. Eastern Time. Now, currently, we are trading pretty flat in the overnight session, so I'm going to add that to the study by going to the opening filters. I'm going to say that the gap size is no more than 20% of the 5-day ATR away from the prior day closing price. So for the S&P, 20% of the 5-day ATR is about 9.25 points. We are currently just trading a couple points higher than the prior day close, but this will allow you to trade in either direction at the open, or the gap will can be in either direction at the open. It just can't be too far away from the prior day closing price. So I've got that selected. Next, I want to go to the price patterns library. And I want to say that yesterday closed at a 10-day low. I'm going to grab that from the new lows category. I'm going to hit equals here next to day after 10-day low close. That adds it to the header section. Now I can go to the indicators, put us in the bull market environment that is weak. And I can do that by saying we are above a 200-day simple moving average. And since I've got a 10-day low close, I don't need to add the 10-day moving average, but you could do that if you wanted to. You could say that it was below a 10-day moving average. All right, now I can click view results. All right, here we go. These are the results based upon entering the market long at the open of regular trading hours, 9:30 a.m. Eastern Time, exiting at 4:15 p.m. Eastern Time, when you get a flat open when the prior day closed at a 10-day low, and you are in a weak bull market environment. So I've described that as below a 10 and above a 200-day simple moving average. Historically, we've got 152 samples here in the S&P to examine dating back to 2003. There's 182 samples in the NASDAQ, 163 in the Dow, and 202 in the Russell. The win rates on them are all mildly favored here. We've got S&P coming in 59%, NASDAQ coming in 59%, Dow 56%, Russell 55%. If we look at the average moves, they are very similar in the S&P. They're pretty similar in the NASDAQ, similar in the Dow, and similar in the Russell. So the average win and average loss are about the same size in all of those. The win rates are a bit more favored, especially more recently, which you can see on those equity curves. Let me just hover over one to make it more obvious. I'm going to pick the S&P here. And you can see since about 2013 or so, it's really been working its way higher. Here's the NASDAQ. You can kind of see that same trend. But somewhere around here, they bottomed and they've been stronger. They were very neutral. You can see they're just going sideways, a little bit of a pullback before that. If you look down below, you can see the last 5 years, last 10 years, a little bit stronger than the overall sample size. Their win rates are a little bit higher there. Let's look at the NASDAQ. NASDAQ last 5 years, about 61. Last 10, 61 as well. Dow, 58% last 10 years, or last 5 years, 57 in the last 10. And Russell, 59 in the last 5, 58 in the last 10. So the more recent years have been a little bit stronger. Long term, it's not quite as strong, but at least for the last 5 years or so, it's been a fairly strong pattern here for the bulls in some of these markets. So hopefully you found that helpful. Good luck today. We'll see you next time.